Welcome to Study Session 5, Costing Methods. Introduction. Costing methods can be described as the means used to determine the amount or value of the economic resources used in producing a product or providing a service. It is tailored in line with the way goods are processed, manufactured, or the way services are rendered. Costing methods can be divided into specific order costing or the continuous operation or process costing. Specific order costing methods include job costing, contract costing, and batch costing. The continuous operation or process costing includes process costing, service operation costing, joint product costing. Objectives. This lecture will enable you to understand the characteristics of the basic costing methods and also be able to solve simple questions on each of the costing methods. Job costing. This is used in case of special order where products produced or jobs undertaken are of diverse nature according to customers' specifications. Separate records are maintained for each lot of products or jobs from the time the work on the job or product begins till it is completed. Job costing is applicable to job printers, engineers, furniture makers, builders, contractors, hardware and machine manufacturing industries, repairing shops, and so on. Job costing enables management to know the trend of the costs as the cost of material, labor, and overhead for every job or product in a department is available daily, weekly, or as often as required while the job is in progress. Ascertain the cost of production of every order as well as profit or loss made out in its execution. It is possible to identify unprofitable jobs. Make a fairly accurate estimate about the cost of similar jobs to be executed in future. Control operational inefficiency by comparing actual costs with the estimated ones on each job. It is possible to identify spoiled and defective work in respect to particular production orders, departments, or groups of workers, and hence the management can fix up responsibility for inefficiency. Implementation of job costing involves the following. Job order number. Every order received is allotted a specific number to be used in identifying a particular job throughout its production process. Production or job order. A production or job order is a written order issued by the production planning department to the manufacturing department giving order to proceed with a particular job. Copies will be sent to all the relevant department managers who will be required to take any part in the production process. Bills of materials. This is prepared and sent from the production and planning department and sent to store and production heads. It serves as authority to collect materials and tools from the storekeeper. Job cost card. A separate job cost card or job cost sheet is maintained for each job in which all expenses regarding materials, labor, and overhead are recorded directly for costing records. Work in process account. This account is maintained for jobs under production either for the entire factory or for each department. The account is periodically debited with all direct and indirect costs incurred during the execution of the job. At intervals, it is credited with the cost of completed jobs to be transferred to finished work account. Example 1. The information given below has been taken from the costing records of an Sopec Engineering Nigeria Limited in respect of job number 415. The details are shown below. You are required to calculate the cost of job 415 and calculate the price to give profit of 25% on selling price. Batch costing. This is more appropriate where products are manufactured in definite batches. This method is used widely in pharmaceutical or drug industries, ready-made garment factories, industries manufacturing component parts of radio sets, television sets, watches, and so on. The costing procedure for batch costing is similar to that under job costing, except with the difference that a batch becomes a cost unit instead of a job. Separate job cost sheets are maintained for each batch of products. Each batch is allotted a number. Cost per unit is ascertained by dividing the total cost of a batch by number of items produced in that batch. Example 2. Biggie Company Limited manufactures computer components and has undertaken to supply 1,200 pieces of a component per month for the ensuing 6 months. Every month, a batch order is opened where material and labor hours are booked at actual. Overheads are levied at a rate per labor hour. The selling price contracted for it is 8 naira per piece. From the following data presented, the cost and profit per piece of each batch order and overall position of the order for 1,200 pieces. The order details as follows. Contract costing. Contract costing is also similar to job costing and is usually applied to work which is of relatively long duration and site-based. It is frequently of a construction nature. Two special issues relating to contract costing are valuations of work done to date for claiming progress payment and recognition of profit on contract in progress. Valuation of work in progress. Depending on the terms of the contract, the contractee advances about 80 or 90% of the work done to the contractor on the basis of the work certified by the contractee's architect or engineer periodically. The balance of 20 or 10% is retained by the contractee, so that the contractor would not abandon the contract if the contract is not proven to be as profitable as expected. The remaining work done, but which has not been certified by the architect on the date of accounting, is referred to as work done but not yet certified. Profit on work in progress. Where a contract takes more than one financial year for it to be completed, it is usual to take into account a part of the profit only to the profit and loss account. If there is a loss, the whole of the loss is transferred to the profit and loss account. What part of the national profit? Take 2. What part of the notional profit should be credited to the profit and loss account each year depends on the practice and circumstances of the case. The general rules are given below. If the value of certified work is less than 25% of the contract price, no profit is taken into account, and the balance of the contract account is transferred to the work in process account. If the certified work is up to 25% but less than 50% of the contract price, profit taken is equals to 1/3 of estimated profit to date. If the contract work has sufficiently advanced or the contract is almost complete, profit taken is equals notional profit, or profit taken equals computed profit. Notional profit or computed profit is calculated by deducing the estimated total cost of the full contract from the contract price. The expenses of the remaining parts of the contract to be executed are estimated and added to the expenses already incurred to give an idea of the total cost. Example 3. The following information relates to contract number 432. you are required to prepare the contract account and the contractee's account, assuming that the amount due from the contractee was duly received. The contract price was 90,000 and the contract took 13 weeks in its completion. The values of loose tools and stores returned at the end of the period was 200 and 3,000 respectively. The plant was also returned at a value of 16,000 after charging depreciation at 20%. The value of tractor was 20,000 naira and depreciation was to be charged at the contract at 15% per annum. The administration and office expenses are to be provided at 10% on work cost. Process costing. This is a type of costing applied in industries where there is a continuous or mass production of uniform, homogeneous items which follows a chain of sequential order. Process costing is suitable for a large number of mining, manufacturing, and public utility industries like mines and quarries, cotton, chemicals, soap making, paper, plastic, alcohol, oil refining, food products. Two special issues in relation to process costing are that of normal, abnormal, losses, gains, and valuation of work in progress. Normal, abnormal, losses, gains. Normal losses are expected losses arising from the nature of the production process. Provision is always made for such losses and must be included as part of the cost of good production. The scrap value of the normal loss is credited to the process account. You obtain normal loss by multiplying input units by predetermined percentage of the normal loss. Abnormal spoilage or defective work may arise in a process due to unforeseen factors. The cost of such abnormal loss is not included in the cost of the process, but in the average cost of the lost units is charged to an abnormal loss account, which is credited with the scrap and closed to the profit and loss account. Sometimes, when the actual loss in a process is less than the anticipated loss, the difference between the two is considered to be abnormal gain. The value of the abnormal gain is credited to an abnormal gain account, which is ultimately closed to the profit and loss account. The scrap value of the normal anticipated loss in the process where abnormal gain occurs is credited to the process account, with the result that the net debit to the process is the cost of abnormal gain less the number of scrap for the normal loss. Valuation of work in progress. Opening work in progress, that is WIP, can be valued by using either average method or first in first out method. For the average method, the unit cost is calculated by adding the total opening work in progress with current period costs. This method fails to account for the fact that the opening WIP units only partially completed in the previous period. For the FIFO method, the first work done in a period is the completion of the opening WIP. The closing WIP is valued by equivalent units, which is the number of equivalent fully completed units which the closing WIP represents. Cost per unit becomes total cost divided by total equivalent production units. For example, a 400 unit WIP that is 50% completed is equivalent to a 200 units of finished production. Inter-process profits. While transferring the outputs of one process to another, the company might add some amount of profits to it. This is to get the actual cost of finished products as if the company would have brought the inputs for the next process. But at the end of an accounting period, this inter-process profit has to be excluded in order to get the real valuation of closing stock. Joint product costing. This is used where two or more products arise simultaneously in the course of production. each of which has a significant sales value in relation to each other. All costs are joint costs up to the split-off point, while subsequent costs can be estimated for each product. The joint costs can be apportioned either by using the physical units, weight or volume, or sales value. If the sales value of the product are not determined at the split-off point because of the need for further process, you will need to calculate notional sales value by deducting subsequent processing cost from the estimated final sales volume. Byproduct costing. This is used where a product results incidentally from the production of another product. Unlike in the case of joint product, the net realizable value of the byproduct is relatively insignificant compared to the value of the main product. In this case, all the common costs will be borne by the main product, and any revenue received from the disposal of the byproduct will be credited to the profit and loss account as miscellaneous revenue. At times, the byproduct may be usable elsewhere in the company or factory. In that case, an estimated value of the byproduct will be the cost of the product replaced by the byproduct. Service or operation costing. This is used for specific services or functions like canteens, maintenance, personnel, hotel, transport, and so on. Cost per service unit is calculated as total cost per period divided by number of service units supplied in the period. This is only possible after deciding the appropriate cost unit. For example, a hotel may use occupied bed nights. For example, Parasol Nigeria Limited produced 3 chemicals during the month of July 2011 by 3 consecutive processes. In each process, 2% of the total weight put in is lost and 10% is scrap, which from process 1 and 2 realizes 100 naira a ton, and from process 3 200 a ton. The product of 3 processes is dealt with as shown below. Job costing method is used where products produced or jobs undertaken are of diverse nature according to customers' specifications. Batch costing used where products are manufactured in definite batches. Contract costing is usually applied to work which is of relatively long duration and site-based. Contract costing is frequently of a construction nature and usually requires valuation of the completion rate of work in progress for profit recognition. Process costing method is when there is a continuous or mass production of uniform homogeneous items which follows a chain of sequential order. It usually generates normal or abnormal losses or gains. Joint product costing is used where 2 or more products of comparable relative value arise simultaneously in the course of production. However, if the value of one of the joint products is significant relative to the other, they are treated as main products and byproduct rather than joint products. Service costing method is used for specific services or functions like canteens, maintenance, personnel, hotel, transport, and so on. This is the end of study session 5. Thank you.